how to determine the enterprise value of the firm and how this has changed and how this enterprise value to EBITDA multiple works. If I want to straight away ask this question to you.
Absolutely. One of the things I've been saying, Shawn, is there's never been a better time to be a CPA or CPA firm. I mean, when you look at valuations today, when I think 3.5 years ago, a firm was very happy if they got 1 times gross revenue. And while private equity and other strategic investors aren't so interested in, what your top line is, they're looking at what's your bottom line, what's your EBITDA. And there's so much that goes into it. There are so many moving parts in determining total enterprise value. But, basically, you're going to take a look at what are your partners pulling out of the business. And in a CPA firm, there really is no such thing as EBITDA, right? It's all compensation.
Hey everyone, this is Shawn Parikh from MYCPE ONE. I have with us a very special friend and a guest today, Phil Whitman. I know Phil since about 7, 8 years now, since early days of Integrity, and we have done a few podcasts back then. It almost feels like watching an old movie when we look at those podcasts now, Phil. It looks
Yes.
like there's so much time has passed, but Phil has been, instrumental in doing many M&A deals, especially where activity are happening. So much activities are happening at in the accounting market. He has been the leader at the forefront of doing this M&A advisory transition, helping managing partners to integrate practices into their firm, and probably he has a suite of services under his parent company, Whitman Transition Advisors, where he help with accounting firms, CPA firms closely. He himself is a CPA, so he comes from the community. So he understands community really well. Like me, I'm also an accountant. So Phil, why don't you go ahead and just quickly introduce? I know most of the people watching this would know you, but as a customary tradition, let's just introduce yourself for 1 minute, and we'll jump into the PE investments and M&A, everything.
Sure. So first and foremost, Shawn, thank you so much. I could think back to when we first met, and the only thing I could think of is how time flies and how I probably had a little bit more hair when we first met.
Yeah.
But I'm Phil Whitman, CEO of Whitman Transition Advisors. As Shawn said, started my career as a traditional, aspiring CPA. I started at Pricewaterhouse before there was a Cooper's attached to it. I was fortunate. Somehow I fell into practice management. Actually, I was working as a senior tax accountant at Citron Cooperman, and they had a client. It was a law firm that was liened and levied by the IRS in New York State. And I went in to straighten them out. And that's how my practice management career was born. I spent 6 years running law firms and then more than a dozen running CPA firms. And it was during my tenure as chief operating officer at Burden LLP that I became really passionate about merger and acquisition and lateral partner talent acquisition. So it was in 2008. It was shortly before, the world fell apart. It was in June that I decided that I was going to leave my firm and start an M&A and talent consulting business. For 6 years, it was me and a stay-at-home mom that helped me do some recruiting. And then I woke up one day and I said, I really have a lifestyle business. I'm not really building something that one day I might be able to sell. And I met with a coach, and that coach is now my partner. And That happened in 2015 when we first got together. And now 10 years later, I'd say we've built the single largest advisory organization for CPA firms in the United States, doing, basically four things, merger and acquisition. And as Shawn mentioned, that includes all the madness that's going on now with private equity and other strategic investors. We also have a talent solutions team, which looks at, permanent placement of people, but also will put fractional recruiters into CPA firms. We also have our profits team, which looks at people, process, and technology. And we have Dave Kells, who's the former chief operating officer from Citrin Cooperman, and he helped them grow from 80 million to almost 400 million when private equity took over. And he's joined our team, and we're proud to have him on board. We also have our advisory services team, which helps CPA firms add other services. So we're doing M&A in other arenas as well.
Wonderful, amazing. Just for the benefit of the audience, the partner, the coach he mentioned is David Wolfskill. He's also a good friend, and we have chatted a few times as well. So we're a fun guy. But yeah, let's address the elephant in the room, Phil. Let's talk more about the activities and the madness going around in the market. And I'm pretty sure that you would be talking on this really 6 out of 10 hours every day. But I'll try to make it more interesting for you. Let's address first thing. I mean, the audience of this podcast would not be ultra large firm managing partners. I'm talking about 5 mil to 30 mil audience. So anywhere from 25 member, 30 member team to 200 member team, 250 member team. And the idea that they are thinking about that with private equity coming in, the valuations of the firms have increased. And the first question I'm pretty sure that you would be getting is how to determine the enterprise value of the firm and how this has changed and how this enterprise value to EBITDA multiple works. If I want to straight away ask this question to you.
Absolutely. And one of the things I've been saying, Shawn, is there's never been a better time to be a CPA or CPA firm. I mean, when you look at valuations today, when I think 3.5 years ago, a firm was very happy if they got 1 times gross revenue. And while private equity and other strategic investors aren't so interested in, what your top line is, they're looking at what's your bottom line, what's your EBITDA. And there's so much that goes into it. There are so many moving parts in determining total enterprise value. But basically, you're going to take a look at what are your partners pulling out of the business. And in a CPA firm, there really is no such thing as EBITDA, right? It's all compensation. It's, last year I made $1 million a year. My other partner made $750,000, and the younger guys are making $200,000 or $300,000. But at the end of the day, when you look at it, private equity is saying, Mr. Managing Partner and Mr. Senior Partner and Mr. Equity Partner in your CPA firm, you might be taking home $1 million, but that's not compensation. For me to get someone to come in and do the work that you do, I might have to pay $250,000 or $300,000. So if you're making $1 million and we're going to pay you 300, or maybe generous, we'll pay you 350, 650,000.
Is it just
what you take home is a distribution of profits.
They call it adjusted EBITDA.
That's right. And well, it will be a component of adjusted EBITDA because you might not be willing to work for 200 or 350. You might say, "Oh, I need to make 400,000 to to pay my bills. So if you're making $1 million, you would be contributing $600,000 to the EBITDA. And let's say I'm older than you. I've put a little more away. You know what? I could work for $250. So I'm going to contribute $750,000 to that EBITDA. And if we were a two-partner firm, that would be $1,350,000. But let's make the math easier. We've got a third partner, and he contributes $650,000. So now there's $2 million of what I'm going to call leave behind EBITDA. Now it's not adjusted yet, but now what we're going to do, we're going to say, okay, we got that $2 million, and you know what? If you have a company car and cell phones, and you're putting through some, health insurance or whatever it may be, let's call them soft costs that, because you're the owner of the business, you're taking some liberties. Well, that's not going to continue when you do a transaction with private equity. So they're going to add that stuff back up. And also, if last year, let's say you had one-time costs. Last year, we decided we were going to buy everyone a brand new laptop, and we redid our space. And you're not going to redo your space every year. You're not going to buy everyone brand new computers every year. So let's add that back because it was abnormal. So now let's say we come up with, you've got $2.5 million, right? The $2 million that the partners are leaving behind, or what some people say, the scrape. What's the scrape going to be? So we scrape $2 million of profitability from the partners, and now we have 500,000 of these add backs. So we're at $2.5 million of adjusted EBITDA. Well, now what's an appropriate multiple to be assigned to that? Because for every one of those dollars, depending on the size of your firm, the niches you're in, your geography, the bench strength that you have, the technology stack that you're using, all of these things come into play. It's going to determine whether or not you get a 5, a 6, a 7, an 8, a 9, or we just saw Citron Cooperman do a deal with Blackstone. They got a 15 multiple. Don't expect 15. Don't lock in on 15. You're not as big as Citron Cooperman. But most certainly we are seeing what used to be, let's call it a 5 to 7 on a firm that was, let's say, between 5 and 10 million. That's now more of a 6 to an 8. And in some instances, we are seeing firms receive multiples as high as a 10. And if you recall, when this all started, Eisner-Amper didn't even get a 10 multiple. They were probably, they probably were in the 9s. Citron may have gotten a 10, and I don't recall. But the first thing, and Shawn, I'm going to share this with you, and I'm sure it's no different in any other business. The first thing everyone asks when they want to have a conversation about private equity is, what's the multiple? Yep. Well, that shouldn't be the first question, because I could show you a deal where you're only going to get a 7 multiple, but that 7 multiple is going to be better than if you got a 7.5 or an 8 multiple, because there are so many other components. There's how much cash are you getting up front? How are you getting the cash that you don't get up front? Are there earn-out provisions that are in there? Do you need to hit certain EBITDA goals? Or is it a promissory note that they're giving you? Do you get to keep your balance sheet? How much working capital do they want? Do you get it back? I mean, there's just so many things. It's dizzying when you think about a private equity deal. Are they a long holder, a short holder? Are they going to turn in 3 to 5 years and there's going to be a new owner group? Is your equity, the rollover equity, if they're not buying 100% of your firm, is it going to be at the local level, or is it going to be at the top co level? And is your private equity group building a one-firm firm, Or are they building a constellation model where they're putting 10 poles throughout the country, sort of the way Crete and Ascend are doing it? And it's amazing what's going on.
But if I'm not wrong with Crete and Ascend, I think they have kept companies independent or firms independent. But if I'm not wrong, they own 100% of the business, right?
Well, it's very interesting. With Crete, typically they don't buy 100%. They'll buy a minimum of 60% of the equity, and I think they'll go to like 80 or 90%, unless you're a add-on or tuck-in to an existing platform firm. In that case, they may buy 100% of the equity of the firm.
Well, then an existing firm would absorb the new firm.
Correct. Now, with Ascend, they do buy 100% of your equity, but then they allow you to, take 10 or 15% rollover equity. So here's all the money for your firm, and then give some of it back to us so that you can buy into Toronto. And that's probably one of the biggest differences, other than people and everyone likes different people. These deals are still all about chemistry and culture. That should be number one. The money's always going to be somewhat close. But, when you look at Crete's model, they're taking that rollover equity and you're getting it at the local level, which means it doesn't matter how all those other firms do. It only matters how your firm does. Whereas Ascend, you're getting the same equity that the folks at Ascend have, and every firm has the same equity. That equity is at the top co. So the performance of every firm that's part of that model will affect, hopefully in a positive way, usually in a positive way, so that if you have an off year and everyone else has a great year, it doesn't affect you as much. It's a sharing of risks, sharing of rewards across Topco. Now, believe it or not, because some firms like local levels, some like Topco, we actually consult with a private equity group. The group is called Trive. They're out of Dallas, and they will give you a choice. You as my partner, Shawn, could say you want it at the local level. I could say I want it at the Topco level. And our third partner could say, I want to put half at Topco and half at local co. And everyone's needs are satisfied. Now, probably a nightmare to keep track of that, but we are dealing with very smart people at these private equity groups.
Yeah, absolutely. And with that, some fundamental questions, Phil. Well, how would non-ownership, the things haven't popped up, but what about regulatory challenges? What about things where I was talking to one of the clients, they're completely closely held and independently owned and operated, no private equity, philosophically don't want to have private equity. And they say that they're getting a lot of clients who are being bought by private equity firms. So they're getting a lot of their clients from them. And one reason is either there's too much price increases, or another reason is change in point of contact, point of relationship. Because of this, they are feeling uncomfortable. They feel that the services that they need won't be available anymore, or some just going virtual to save money, save cost, and everything, all possible way of cutting the corner than improving the EBITDA. So as you mentioned, culture and chemistry being at the center of it. This is a personal service business, and if you don't have ownership, we have a business where each partner is responsible for a book of business. That's how this has been run for years. And now, ultimately, it's being a personal service business, being available at 7 times, 8 times, 10 times, God knows how many times. So, it's the fundamental challenge. what is the motivation for a partner to do right by the client? What is the motivation for the partner to right by, the
So,
business?
so what I can tell you is, in the models, where they're buying a majority percentage of the business, they're investing in the firm, and let's say they're taking 70% of the equity, and the partner group's holding 30% of the equity. The desire to retain those clients, service them as good or better than you have in the past, and hopefully there'll be more resources available because you can have other firms with other areas of expertise. And in many cases, you might have, the ability to increase profitability to the extent that you've never done offshoring. And one of the things I can say to every firm out there, and Shawn, this might sound like a plug for your offshoring business, and it absolutely is. So we have our profits team, and our profits team will go into a CPA firm and help them increase the levers that are going to help them get a better multiple in the future when they do a transaction with private equity or someone else that wants to invest. Now, the things that we look at are people, process, and technology. So let's take the people part. If you do a transaction with any private equity group and you're not doing offshoring, get ready, because they all either have an offshoring group or have partnered with an offshoring group like Shawn, or they have a desire and ultimately will build or acquire an offshoring group, just like Ascend did with Sentient. But what I can tell you is they're going to increase your profitability by adding offshoring. So why don't you add offshoring now? Don't wait until you do a transaction and they force you to do it, because think about this. You bring someone in. Let's say you bring in 10 people, 10 managers, okay? 10 tax managers. And maybe you're going to pay $5,000 to $6,000 a month for those tax managers. Am I right, Shawn? About $5,000 for a senior tax manager, $50,000. Let's just go with that. The person or people you're trying to get here in the United States as a senior tax manager, you're going to pay anywhere from $120,000 to $250,000, depending what geography you're in. But let's say you even just pay $150,000. So now, instead of paying $150,000, you could pay $50,000. That's going to put an extra $100,000 to your bottom line. And let's say the multiple that they're going to pay you is a 7. Well, by offshoring, you just increase the value of your firm. One person, $700,000. I said, let's assume you bring on 10 of those senior tax managers. You're a large enough firm. You just got an extra $7 million in valuation. Don't wait to offshore. Number one, I think it's no longer optional, because the talent market is really tight, and now there's an even better reason to do it. Not only the money that you're going to save today and the increase in your profitability, but the valuation that you're going to get tomorrow, or 2 years from tomorrow, or 3 years from tomorrow. It's a no-brainer. It's a no-brainer to be offshoring. And so I don't know if I exactly answered your question, but the partners that are holding that remaining 30% of the equity. Private equity buys 70, invests in your firm, you're sitting there with 30. It is my belief that if you grow your firm and you increase your profitability, and you're going to do that with the help of private equity having a capital stack that's going to enable you to do acquisitions, enable you to buy the best state-of-the-art technology with artificial intelligence, that 30%, you should end up with as much or more cash for the 30% as you did for the 70% day one of that transaction. But you got to service those clients. You got to retain those clients. So the motive for servicing the clients, bringing in new clients is, well, do you want to get a big check for that second bite of the apple? Like the guys at Citron Cooperman did? Imagine this. If they had 1 million units of the rollover equity that were valued at $1 when they did that deal. Now, we don't know the exact number, but that $1 million worth of units, 3 years later, is somewhere between $3 and $4 million. 3 to 4x on their rollover equity. That's huge. That's huge.
I think it's just that's how the roll-up works. But honestly, that's not the question. The question is, it's more about the culture, more about the impact on the business. Again, I'm sold on the finance of that. I'm sold on to the numbers of that. So I think that looks all mouth-watering, if for the lack of the better word. And again, this kind of numbers accounting industry haven't seen before. And I view it from a point of cautiousness. How can a personal service business be valued at 15, 18 times multiple? So I view it from a very, very different standpoint compared to what. And again, these are golden handcuffs for the people who are staying in, and transparently so. I'm saying that it's capital. It's capitalism at its best. I have remained private. I think you have remained private as well, Phil. That gives a lot of freedom to do what is right by your client, what is right by your team. So you don't have any other external stakeholder to take for. And if you need capital, definitely go for it. Raise it to growth, etc. In most cases, what I have observed is these firms do not need capital.
So here's the challenge.
Yeah.
It's my belief that in order to effectively compete in the future, firms are going to need a capital stack. Just by way of example, we work with a firm that's just outside of the top 100, somewhere between 100 and 200. And they said to me, Phil, our merger and acquisition deal flow is drying up. As a matter of fact, there's a firm that we were wooing, and now everyone is asking for cash up front. We were willing to give them $3 million cash up front, but private equity came and gave them $10 million cash up front, and we lost that deal. And we're not seeing much deal flow because now everyone is holding out their hand for cash up front. So I think we need an investor, whether it's private equity or a family office, it's a bank holding company. I mean, there are so many different investors out there, but we need the capital stack so that we can compete, and wages are rising. And ultimately, if we don't do something, we feel that just growing organically is not enough. Now, the flip side of that, I think the question that you really want to know, and perhaps what you're alluding to, is private equity comes in and, they're seeking a return on investment. The one thing that everyone should know is private equity comes in and they have a seat at the table because they're a new partner in this business. And in most cases, they're the majority holder. But the reality is they know very little about running a CPA firm. And for 95% of the partner group, the day after you do a transaction with private equity, it's business as usual. Even you take a firm like Eisner Amper, if you were to talk to Charlie Weinstein, the CEO, he would tell you for, I'm going to use the term, the rank and file partner group and everyone else in the firm, their day job has not changed at all. Now, Charlie's job has changed. He's got to present at a board meeting every month. He's got to ensure that they're hitting whatever those numbers are. And obviously the leadership in the team now have a new master that they have to report to. And as Shawn said, Shawn's a private equity company. Shawn, who do you report to? Right? Who do I report to? Well, the reality is we report to every one of our employees. We report to every one of our clients, where we are truly, when you're running a private business. Yeah, right. If you wanted to take the rest of the day off, Shawn, you could. You don't have to ask anyone. You can go play golf, you can do whatever you want. But I don't think private equity is coming in and saying, change the way you work. You can't do that stuff anymore. I think it's pretty much laissez-faire. They are leaving things as they are. And I think when you hear about organizations losing clients, and I have one firm that I work with that says, yeah, they're losing partners and they're losing clients. And I think for the most part, the partners that you see transitioning out of a private equity-backed firm are typically not the highest performers in the firm. And they're partners that, regardless of whether or not private equity came in, they would probably be on that path and on that road to be making a change anyway. And it's always hard to tell why a client leaves a firm. Private equity is not coming in and saying, Shawn, you got to raise your fees on every one of these clients. I mean, they're being reasonable. They understand that ours is a people business and a relationship business. And I would even say my clients would probably say to me when I tell them that I'm doing a deal with private equity, they would probably ask me three things. First, they would say to me, Phil, is this good for you? Second, they would say, are my fees going to be the same? Third, they would say, am I still going to get the same quality of work? And that's what they care about. So, I think that, everyone takes I took a client from XYZ firm, and there's a lot of puffery around it, around why they lost it. And for all we know, those were clients that the firm wanted to get rid of. We just don't know.
One thing is also that these are private businesses. Not everything is out there in public domain. So, and then I have learned about some stories which are not really good as well. So, and I'm absolutely. I mean, I told you Dark Horse is our client, right? So I forgot the name of I think Chelsea or something. I forgot the name of the CEO. He wrote something about private equity, and he said that culture and people are being ignored when private equity is coming in. And my response was, it's capitalism. People are taking it, legally. It is happening under the rules of the game. And, so I view it in a very logical sense. But my view, again, I reserve the right to disagree that in most of these cases where it is being positioned as this is a requirement of the capital, mostly it is not. The reason is either the expectations of retiring partners are increasing and that's the requirement of the capital, or it is being positioned that you require technology and human talent and for that you need capital. I don't think cash flows of businesses itself are good enough to acquire talent to realign tech stack. You're not building plant and machinery. You are not building gigantic offices and retail stores or infrastructure. You're a personal service business. So uh, the argument of capital is still, I mean, according to me, unless it's a growth capital. I think if you want to go grow acquisition route,
Growth capital.
absolutely. It's a growth capital, fair enough, that you can't do without capital. It will limit your growth to the cash flows that you're building up. But if you want to speed that growth, you need capital. So I buy that argument. But other than that, most of the argument, according to me, when it comes to requirement of the capital, and on top of that, the argument is, PE firm comes and corporatized everything. You don't have a multiple partner to report to. Otherwise, it's always a hung board in most of the decision making when you're doing this. But I've seen a lot of firms who have done it without private equity, successfully done it. You don't need a private equity to restructure the management. I think you advise a lot of firm in restructuring, and for that, I don't think they need private equity. So, and I'm not against private equity. My point of view is very simple, that evaluate your needs for longer term. I think we talked about Smith and Howard. I think they have done wonderful thing, minority deal, and all the money, including the cash flows, are being used in acquiring firms. The majority, all partners still hold majority of the business, and majority would be, I don't know the actual number, but my instinct would be 80% plus is still with the operating partners. And they have still done, or to the best of my knowledge, they have increased, they doubled their size, they've bumped into top 100 category. I think wonderful business, great metrics, one of the top revenue per employee company, very efficiently done, very corporatized, and PE has one seat on the board. I mean, I could be wrong on these, but this is my evaluation of the data available in public market. So there are firms who have done it in a really good way. I mean, I was talking to one of my clients, and they're saying that, small firm, 40-member firm, 4 partners, and 3 partners will be retiring in the next 5 years, and they're looking at private equity as one of the options. And now, there are 5 partners. The 4th and the 5th partner says that if the 3 are retiring, I don't want to remain in this business. I'll tag along. So they don't want to be in the business anymore. So, and another problem is nobody wants to do work. So that's some of the challenge. So
we do work very hard, Shawn, in public accounting. We do. But you know what? I think any business, any profession, if you want to have the respectable earnings that you achieve as a partner in a CPA firm, you are going to work hard. And here's what I would say. While I believe that there are going to be very, very successful private equity transactions, like the Citrin Cooperman deal, like Eisner-Amper, they're going to do a great deal, like Ascend, like Crete. I mean, these are organizations that have grown tremendously and shown value to the firms that they've partnered with. And notice I've used the term partnered with. This is more of a partnering model that has been developed by private equity. They see it as a very profitable business. Now, private equity isn't for everyone. We know that there are going to be firms out there that aren't profitable enough, or maybe they just don't want to be part of a private equity-backed firm. Maybe they don't want family office backing. Maybe they do believe they can make it on their own. And here's what I would say to them. Our message at Whitman Transition Advisors, going back to even when we were Whitman Business Advisors, going back 17 years, has always been, because it's your life. And because it's your life, you know what? We're going to help you and provide you, regardless what your vision and your goal is. We're not a hammer and nail organization. If you want to talk to private equity, We'll set up meetings. If you don't want to talk to private equity, we will continue to work and help you with mergers that perhaps those firms aren't interested in private equity either. I mean, I will say this, in 2023, of the 30 transactions we did, okay, 6 of them were with private equity. That's in 2023.
Wow.
In 2024, we did 30 transactions with private equity, and we only did 6 transactions that were normal CPA firm to CPA firm. It completely turned 180 degrees from this to this, and private equity just seems to be, very, very much in favor. Now, many CPA firms know of a client or more than one client in some other type of business that took a private equity investment, and they know of the horror stories. Okay? I truly believe private equity groups have approached the accounting industry very different than they've approached, the roll-up of car washes or the roll-up of body shops. It's a totally different business. It's a business where the assets walk out the door or go up to their bedroom, because obviously everyone is working from home these days, but people vote with their feet. It's a people business. And I believe that you look at an Ascend, they're a people first model. You look at a Crete, they're a people first model. You look at so many of these firms and they recognize that it's all about the people. You can only cut costs so far. We are a revenue-based business, okay? Again, one of the areas you can is in the offshoring area. And again, very important that if you want to increase your profitability, you certainly should be offshoring. And when you hear that offshoring doesn't work, it's not that there are problems overseas. It's that there are problems in your firm, that you don't have the process down, that you don't have your partners utilizing it to the extent that you should. It's an internal failure, not a failure on part of your provider that's overseas. But that could be a whole nother topic for another podcast. But what I would say is, even if you're not interested in private equity, you owe it to your partner group as managing partner of a CPA firm to have an awareness of what's going on. So by listening to podcasts like this, and also take a meeting or two, find out for yourself, okay? Talk to other firms that have done it. There's no mystique about this anymore. We've seen a very large firm have a very, very positive turn or new investor coming in as Blackstone took out New Mountain. I mean, if you think about it, Citrin Cooperman validated the model that private equity can work and does work in the profession of public accounting.
Absolutely. And I think we can continue having conversation on this. I think 1:34, we already passed our scheduled time, but Phil, thanks for your time. Maybe we'll do it
Been
again.
A pleasure.
Yeah, I'll invite you again to our PE webinar series that we're doing, PE and family office investments and things around that. So would love to host you there as well. But thank you for your time, always, getting insightful perspective on things happening around accounting industry. Yeah, thank you for your time.
Always a pleasure. Thank you for your friendship, most importantly, Shawn.
Thank you. Thank you, Phil.